Wait a minute. Where? Hi everyone, I'm going to present my project titled Innovative PE Fund Forecaster, which is part of the broader initiative. Alternative Investment Advisor. The project has been generously sponsored by Alan Frank, to whom I send my deepest gratitude. The presentation will cover key finding, introduction, problem statement, methodology, results and analysis, discussion, and conclusion. The growth equity, the first part is the introduction. The growth equity and private equity worlds offer high potential returns but notable risk. Analyzing these investments is challenging due to their complex dynamics and opaque market nature. My project is to revolutionize how investors approach these challenges by leveraging advanced statistical and machine learning techniques and analyze and predict growth equity fund performance accurately, empowering informed decision making. As I dive into the core of my project, let's highlight the key findings and only define the success of my research, but also pave the way for new investment strategies. Risk-reward profiling through cluster analysis reveal distinct risk-reward groups, allowing target investment based on personalized risk tolerance and returns. Trend analysis highlighted fund managed by inside venture partners, considering damage-driven risk-adjusted return, a crucial insight for focusing research on promising opportunities. Trend analysis highlighted funds managed by inside venture partners, considered sector analysis found consumer products and services showed a strong positive impact, enabling sector-specific strategy optimization. The LSTM model, a standout achievement, was significantly reducing IRR forecasting error rates below IRR's inherent variance itself, underscoring the model's precision and reliability in predicting future fund performance. Then is problem statement. The challenge was that traditional metrics like IRR don't fully capture what influences the success or failure of this complex opaque growth equity and P equity in investments. Sponsor Alan Frank wanted to dig deeper into understand the real drivers of fund performance, especially in tech, to help investors make smarter, more informed decisions. So I set out not just analyze these funds superficially, but truly understand them and predict their future trajectories, making investing less uncertain. Then is methodologies. My methodologies was structured into mainly 3 stages. First, I collected fund performance data and applied hierarchical clustering to identify nature groupings based on metrics.
Recording in progress.
Either merge this with detailed investment profiles to analyze how sectors influence overall performance. Second, I used feature engineering techniques like polynomial features to capture complex variable relationships. Correlation analysis and visualizations like heat maps helped explore underlying patterns and refined strategies. Finally, I constructed intensive testing using methods like cross-validation to validate and iteratively refine my predictive models based on metrics like R-square, root mean square error, in enhancing their accuracy and reliability. Then come to the most important part of my slides, results analysis. I will present in these 4 sectors in such sequence. Okay, in my cluster analysis of growth and expansion funds, I focus on differentiating the funds based on their performance characteristics. From 2013 to 2023, I defined 3 distinct groups. conservative growth and efficient capital utilization. This cluster consisting of funds like IX and the VII demonstrate consistent and substantial growth in their total value to paid in metrics indicative of strong value creation. Fund IS, for example, showed a notable upward trajectory in its internal rate of return, reflecting successful strategic maneuvers and operational efficiency. Mixed performance with potential for value realization. Fund X reached a performance peak around 2022, followed by a notable retrajectory in TVPI and residual value to paid in. This pattern suggests significant strategic shift or adjustment in asset valuation. High growth with substantial value potential. Fund XI displayed dramatic fluctuation in its IRR, with a sharp peak followed by a steep decline, highlighting periods of high returns countered by subsequent market correlations. Fund XII, on the other hand, exhibits both high performance, especially in its RVPI, indicating changing market conditions or internal management efficiency, affecting its unrealized value. This finding not only aid in understanding fund behaviors, but also assist in tailoring investment strategies to match investor risk tolerance and growth expectations. Then is moving to my comprehensive trend analysis. I dive deeper into financial dynamics and the strategic position of each fund over the past decade. Fund IX and VII both display consistent and substantial growth in their TVPI metrics, indicative of strong value creation and investment returns over excessive period. Fund IX in particular demonstrate a notable upward trajectory in IR, reflecting successful strategic maneuvers and operational efficiency that bolster its financial performance. And Fund IX showed dramatic fluctuation in its IRR with a sharp peak followed by a steep decline, a pattern that underscores periods of high returns countered by subsequent adjustments of market corrections. And these two are the typical trend of the 5 funds in this I researched down, and especially XI. Then is my risk-adjusted return analysis. My risk-adjusted return analysis provide a revealing snapshot of their performance dynamics, employing metrics such as the Sharpe ratio and Centennial ratio to highlight bright variations in risk management and return profiles. Fund IS has a Sharpe ratio of approximately 0.994, suggesting nearly equal returns per unit of risk taken, with an average excess return of 0.17. A Centennial ratio of 2.67 indicates effective management of downside risk, making it a stable choice for conservative investors. Fund VII exhibit a higher Sharpe ratio of 1.43, reflecting better performance per unit of risk compared to Fund IS. The Centennial ratio of 3.75 further emphasizes efficiency in handling negative variations, appealing to risk-averse investors. Fund X stands out with highest Sharpe ratio of 1.554 amongst the analyzed funds, coupled with an impressive Centennial ratio of 9.78, pointing to an excellent risk-adjusted performance, particularly in managing downside risk. Fund XI presents an intriguing case with significant average excess return of 0.46 and a Sharpe ratio of 1.118. The Centennial ratio of 22.449 sets its funds apart, indicating its exceptional ability to generate high returns will minimize negative outcomes. Conversely, fund XII shows a troubling profile with a negative Sharpe ratio of negative 1.4 and a negative sorting ratio of negative 0.826, revealing underperformance relative to the risk-free rate and the inadequate downside risk management. This detailed insight into each fund performance help us understand not only their past behavior, but also their potential future trajectories, guiding investors towards more informed strategic decisions. In this section of the analysis, I explore how the performance metrics of funds vary by their IR quartiles, providing a clear view of what distinguishes top-performing funds from those that underperform. This comparative study highlights a common characteristic and financial metrics of funds based on their quartile ranking. Total top performers, such as those in the highest quartile of Fund IX, especially exhibit high TVPI and DPI. For example, the top quartile in Fund IX showed an average TVPI of 2.99 and an average DPI of 2.117. This metric suggests that top-performing funds not only generate substantial growth, but also efficient at returning capital to investors. On the other hand, funds in the lowest quartile often display significantly lower TVPI and DPI. For instance, the lowest quartile fund IS has an average TVPI of just 1.48 and a DPI of 0.8, indicating less effective capital growth and distribution. Similarly, Fund XII's bottom performance struggle, showing lower overall values and minimal cash distribution, which highlights potential areas of concern. These observations are critical for understanding what might be expected from funds that perform well versus those that do not. By examining these characteristics, investors can gain insights into the financial indicators that might influence a fund's performance, helping them make more informed decisions about where to allocate their investments. Moving to our sector-specific performance insights, my analysis illuminated how different industry sectors impact fund performance metrics. For example, the consumer products and the service sector showed very strong positive correlation with DPI and TVPI, indicating that investment in this sector significantly enhanced fund performance and investor returns. In contrast, the IT, information technology sector, despite increasing fund size, showed negative correlation with IR and TVPI, suggesting potential risks that could impact returns. Similarly, the health sector, while promising in terms of long-term value growth, showed a strong negative correlation with DPI, indicating challenges in generating immediate financial returns. Based on this finding, I recommend investors maintain a diverse investment portfolio to balance risk and capitalize on growth opportunities across sectors. This strategic diversification will allow investors to manage risk effectively while exploring growth potentials in different sectors. And in my projects, you can see the graph here. I use random forest and gradient boosting to find feature importance that I will use in the LSTM model. I integrate a long short-term memory model to refine our forecasting for private equity funds. This advanced model is ideal for analyzing sequential data and capturing the intricate dynamics typically missed by traditional methods. The model using predictors like IR lag 1, which is a previous quarter IRR, TVPI and RVPI excelled in leveraging historical performance data into predicting the next quarter's IR with remarkable accuracy. It has an error of 0.0 0.0165, significantly outperform the variance baseline of 0.026, demonstrate high predictive accuracy and the ability to capture finer fluctuations. Okay, this is all the findings. In my discussion today, I've encountered several key insights. The cluster analyzes successful categorized bonds into distinct groups, helping to identify their risk-reward profile, which aids in informed portfolio diversification. Sector analysis reveals that investment in the B2C sector significantly boost fund performance and distributions, while IT shows potential volatility and healthcare faces challenges in generate immediate returns. Lastly, the LSTM model's high accuracy in forecasting IR demonstrates its utility in enhancing strategic investment planning, leveraging historical performance data into to predict future trends. These insights collectively offer framework for optimized investment strategies and diversifying portfolio effectively across various risk-reward profiles. Then is a conclusion. To conclude, my research offers several strategic recommendations. Adopt a diversified portfolio approach, balance investment cross-cluster with varying risk-reward profile, optimize returns while managing risk effectively, increase exposure to B2C sector, while being cautious with investment in IT and healthcare, aligning them with growth opportunity and risk mitigation strategies. Utilize the predict capability of the LSTM model to enhance strategic planning and investment allocation decisions, enabling precise and data-driven decision making. Continuously monitor fund performance, market trends, and sector dynamic to adapt investment strategies proactively, ensuring they capitalize on emerging opportunities and address potential risk. By following this recommendation, investors can navigate the complexity of the PE funds landscape with greater confidence, aligning their portfolios with the potential growth and matching their risk tolerance and the risk return objectives. And that's all. Thank you. Do you have any questions?